Global markets plunged this week on inflation fears, particularly the Nasdaq in the United States. Markets are now pricing in a 75 basis point rate increase from the US Federal Reserve next week. And that fall in the markets has hurt the superannuation balances of everyday Australians. I caught up with Deanne Stewart, the Chief Executive of Aware Super, Australia's third largest super fund, talking asset returns, investment opportunities and merger and acquisition deals.
Yeah, it's been a really challenging last 12 months, no doubt, and when you look at what's going on in the markets with really significant headwinds really impacting the market. So if you look at the 12 months to June 30th, you literally had the ASX down over 10%, you had the S&P down over 12%, you in fact had Nasdaq down over 20%. So you had really significant downfall in markets. Most of the super funds, though, like Aware Super, because we're so diversified, certainly we had negative returns for the 12 months, but they were really in low single-digit negative returns. And that's just the power of diversification. So we've got assets like infrastructure, property, private equity, as well as equities, cash and fixed income. And so that diversification actually really does help protect members, both in the short term, but particularly in the long term.
Can you just sum up the state of the Australian market at the moment? Are there still plenty of investing opportunities in Australia, or are you now focusing overseas?
Yeah, look, it's definitely a period of lower returns and of very volatile markets. But for us, we're seeing plenty of opportunities, both here in Australia and internationally. And certainly a fund of the size that we are, 150 billion, you've really got to make sure that you are investing both in international markets and opportunities as well as here in Australia. Here in Australia, we certainly really want to participate and are participating in some of the really big investment themes like the energy transition. Lots of opportunities both now and into the future that we're looking forward to being a major participant in. But also in things like, for example, build to rent. That's a really nascent segment here in Australia, but we see really significant opportunities there and are one of the lead investors here in Australia. Similarly, overseas, though, we've also participated in really significant developments, whether it be ports, whether it be major infrastructure, or indeed service departments, build to rent in both the US and in the European markets. So we certainly look to invest in both where the best opportunities are for our members.
You talked about the energy transition. How mindful do you need to be of infrastructure assets emitting carbon?
Hugely. So without a doubt, climate change risk is the biggest risk in an investment portfolio today. No matter which industry you're looking to invest in or which asset you're looking to invest in, the ability for that asset to adapt and transition to a lower emission profile is critical. So we've certainly been able to do that more easily in our listed equity portfolio because a lot of listed companies do disclose what their carbon footprint is. What we've now done in all of our unlisted assets, so our properties, our infrastructure, is actually baseline the carbon emissions of each and every one of them. And now we're on a pathway to reducing those emissions over the next 5 to 10 years. That is a mammoth undertaking, but a really critical one to be part of the net zero for both Australia and globally.
And is this something you think all super funds are starting to get into? Or?
I certainly think so. I think different super funds are at different stages as it. We'd like to think we're really leading the way. We certainly led the way on what we've done on the listed equity side. I think we're one of the first to have baselined our entire unlisted equity portfolio. So I think we certainly feel like we're leading the way, but my understanding is a number of other funds are looking to do something quite similar.
And how much of that change has come from your own super fund members who want you to start doing these sorts of things?
Oh, there's no doubt that our members want to do that. If you look at certainly Aware Super, our fund, at the heart of our fund, we're certainly open to all Australians, but given the history of it, we've got a lot of essential workers. So you're talking about teachers, nurses, doctors, fireys, police officers, people at the front line seeing the impacts of climate change. So if you looked at letters that come into our fund, I could guarantee that the number one reason for letters into our fund is what are we doing around climate change. So they are certainly care deeply about what we're doing, and we certainly communicate that very regularly as to where we're at and what we're doing going forward.
And how quickly can you make a decision on an M&A deal? Because you've done a lot of deals over the last 12 months.
Yeah, it's really true. We certainly have done a fair amount. So we've done things like taking Vocus private, for example. We've been a lead in that consortium, taking Vic Roads, working with the Victorian government, for example. So we've done a fair amount. Together with mergers in the super industry, we've actually undertaken several mergers there. From an investment perspective, exactly what you just said, our team we've really over the last 5 years built out the right capability and skill, both to be able to undertake these sort of investments, but exactly to what you just said, is to be able to go at speed. And we think it's one of our competitive advantages, is that we can actually take on one of these deals. We've got the right capabilities, the right skills, and the ability to do that at pace is actually a competitive advantage. But so too is the ability to play right across the capital structure. So whether it's debt or whether it's equity, we can certainly play on both sides and have sort of the key resources and capability to do that.
You mentioned your build-to-rent portfolio. I know you're trying to grow it to be $7 billion in size, but rental vacancies around some of Australia's capital cities are around the 1% mark. So is that a big driver behind that build-to-rent portfolio?
Absolutely. If you look at Australia at the moment, we have a housing affordability crisis. There is no doubt about that. And one of the huge contributors to that is the lack of supply. And so build to rent, while it's not the full solution, it is actually a really core part of it, particularly for young people coming through. Rent is really high at the moment. You look over the last couple of years, it's increased 15 to 20% per annum. There is a lot of Australians hurting and not able to pay their rent. So increasing the supply of really affordable, high quality apartments is a really core part of our strategy. We've got in our pipeline now about $1.5 billion, but as you said, we'd like to continue to scale that up. We see it as a really good investment opportunity for our members.
With the change of government, has there been any changes to the way that you go about your business?
Look, I certainly think over the last couple of years there's been some really significant changes from a regulatory perspective. From our strategy perspective, I think we probably anticipated a number of the big themes playing out and have really adjusted our overall organisation accordingly. So if you look at some of the big themes, they would be two of the biggest is the consolidation in the market. So instead of there being 150 odd super funds, we certainly see there being a much smaller number, certainly a very competitive field, but certainly less than 150. And so we've really led the way on that front. We're undertaking several mergers over the last couple of years because we think scale matters. Why does scale matter? Because ultimately what you want to do is lower the cost to serve for members and lower the fees for our members, because we are a profit for member fund. We want all the benefit to go back to members. So that's been one of the big changes that's occurring, and the regulatory environment has really led it that way. The other big theme is around choice. And ultimately, as the market moved from just being more default orientated to being Australians choosing what super fund, then that's why you're certainly seeing players like Aware Super do a lot more in the space of really making sure that their brand is known and really making sure that what we're doing is exactly what members value. And so for us, for example, we've spent a lot of time, energy and dollars in really building out our advice proposition, because while members really want good returns, that's exactly what we're there to do, really good retirement income, they also need the help and guidance and advice at times, particularly when they're nearing retirement. And so we really want to get the two right and really lead the way in both of those elements.
And do you think super funds now have more of a seat at the table when it comes to communicating and interacting with government, given Labor's history of coming up with super?
Look, there's no doubt that superannuation is huge and significant. It's $3.5 trillion now. That is the third largest asset pool in the world. Now that's really significant when you consider we're the 13th largest economy, so it gives you a sense of just how successful the superannuation system has been. So certainly as that relates to then interacting with the government, if you think about a couple of the government's priorities, whether it be the energy transition, whether it be housing affordability, certainly the role that super funds can play is significant in that, but only when and if it really creates really good returns for our members. So that's certainly the conversations that we're having with the government at the moment.
Deanne Stewart, Chief Executive at Aware Super, thanks for your time today.
No problem, Ed. Thanks very much.